Christmas, Christmas, Christmas. But today it's not about the Christmas. I would rather tell about the New Year that is coming and the New Year's resolutions with that. So I don't wanna teach you what we need to do uh, to become a happy person in the 2023. But I will tell you something else, a bit more explicit on some cases. So many of you may be just starting with investing, whilst the others will be booking profits or losses in 2022 end of December. So when you be summarizing the 2022, don't forget about important elements. So no matter at what investing or trading level are you, I need you to remind that emotions often strikes us after losing or winning streaks alongside recapping period. So after recapping periods, you have black on white what your performance been. So never treat the dip that you encounter on the market as though it was the last dip on the way. Also, never treat that shakeout as irrepeatable. Don't underhedge yourself, even if you expect that the worst is over. Otherwise, you get lost and will only be able to apply for supporting role as depicted above series. My name is Rafał Leszek. Welcome to Blockrevision. I'm taking you on a journey called our vision, Blockrevision. We will learn about the secrets of knowledge of investing and trading across many assets, whether it's crypto, commodities, stocks, indexes, everything indeed. So I'm glad you're here. Let me find out first whether we are live and nothing has broken since the beginning. All right, we are officially live. So let's get to intro. Alright, so economy view is the subject that's kicking off our transmission. So what's the first element? Let's get over. The question is to 2023, whether it be the worse for stocks than 2022. So I would say, yeah, everyone is praying for better returns in the next year as unless you are playing shorts. The only investors that were playing shorts might be cheerful right now. But otherwise, yes, that was quite a bumpy and difficult year. Right here, you can see, however, the latest performance of S&P 500 of December 21st, 2022. That this risk gauge, recent peak was at it was around 38.7. I remember 38.7 hundreds on S&P 500. So right here you will find the performance on x-axis. You have the date, the every single 10 years since 1930, and right on your y-axis you have the performance. So we can see that we have got mishmashed throughout particular periods, but mainly stocks were up. So after such a bad year, what do you mean that we'll need to brace for another very unpleasant 12 months. So consecutive down years are rare for stocks. So after this year's drop, there is only a low probability the market will decline again in 2023. In the benchmarks, almost 100-year history, such occasions are clear outliers. Yet, when they have occurred, drops in the second year have always been deeper than in the first. So, as you can find right here, right there as well, with this and that periods, with an average decline of 24%. It would mean that that would exceed this year's slide of about 20% to date. The concerning fact is, however, that more than 2 back-to-back years in the red are even rarer. The S&P 500 tumbled for 3 straight years from 2000 to 2002 and from 1939 to 1941. The longest losing streak remains at the aftermath of the infamous Wall Street crash, when stocks fell for 4 years from 1929 and 1942. This recent months marked the tug of war that have been seen in the second half of the year will likely continue in the first quarter of 2023 unless and until the Fed gets to their terminal Fed funds rate. So for me, by May, as this terminal Fed funds rate I expected to get, you may see kind of a bumpy road, but with expectations that this highest interest rate level has been achieved. That means that during this kind of a halfway of a year, we would expect the markets to rebound fiercely. So if you're wondering about accumulation of stocks, dollar cost averaging, when you're buying the stocks by the depicted amount of money every single month or every single 3 months, is absolutely desirable right now, as those performance should get better if you considering that will be a mild recession. But if it get to kind of a hard one, I wouldn't be such obvious right then. So dollar cost averaging right now, after such a slide of more than 20% from peaks, is absolutely great one. But I would await with some possible slide that may get us even to down to 30%, as we do know that there are many elements of the market that may happen as a black swans, that right now, where this liquidity being drained, are much more likely to happen. Fund managers, however, expect the next year to be better, and for this one, I would need you to jump over to another window that's world's top money managers see global stocks recovering in 2023. So the informal survey of 134 fund managers incorporates the views of major investors, including BlackRock, Goldman Sachs, M&D SA, and that was conducted between November 29 and December 7th. That was the outcome of this prediction, and you can find right here that the performance for the next year is about to get us up to 10%. So the average return of S&P 500 is around 9 to 10% yearly, on a yearly basis. So they are expecting that the next year may get us back to this average performance. When it comes to specific sectors, respondents generally favor companies that can defend earnings through an economic downturn. Dividend payers, insurance, healthcare, low volatility stocks were among their picks. Right here, you can find a damaging stagflation mixes fund managers' big worry, but they're expecting this worry to stay with still strong recession side and stubbornly high inflation. About this recession, we've already discussed yesterday. If you haven't watched, you may do it right after this broadcast. As there are much more about the possibilities of happening such event. So investors may return to tech and Chinese stocks. That's what also survey found, but there are merely hinged on that those economies should eventually avoid strong recessions. So otherwise, those outlook wouldn't be such favoring. All right, now we are getting back to our projections right now into slides. Right now, we can assume that parties will be going on till wages be rising. So we had elements of rising inflation, but those wages were rising alongside. So real wages recently maybe are less in an upward spiral than it was back in the first half of 2022 and second of 2021. But clearly, there is a concern about lasting labor shortages, and the implication for prices has filtering up to Powell. For now, as we can find, these elements are lowering down. Consumer confidence is absolutely recovering, but it doesn't mean the worst is over yet. So we have slumped back to this level of around 100, 110. So it's giving hopes for better tomorrow, but absolutely the earnings is the one thing that still may put many investors on the sideline by observing, for instance, what's happening with Tesla and other tech companies. So projections for jobs are getting, however, less and less optimistic as well, and you may find it also right here at this tendency where you have variance and mean from recent 5 years. Yes, this slide was one of the factors that outweighed that tendency is lowering anyway. We are still nowhere near from the levels of non-manufacturing employment in ISMs to where we were back before a pandemic. So the faltering jobs market is another concern that economists may consider when making their projections. Recently, we've also seen a debate about how hot this labor market is indeed, where after releasing this Federal Reserve's Bank of Philadelphia report on 13th of December, Joe Biden became a subject of accusations of him being lying to the American people about the economy to prop up his agenda. I will just show you out what was it all about, and that was this research department that been releasing the data. The aggregate 10,000 net new jobs were added during the period, rather than the over million jobs estimated by the sum of the states. USCS estimated net growth of over million jobs for the period. So yeah, that was the element of a debate. What does it mean? Did it mean that we've been lied by some entities? But it was just a preliminary projections versus actual results. That's why these elements presented previously need to be tweaked, and we can find that these elements are right now somewhat lower. So early benchmark showing that these elements will get worse from now on. So yeah, it was the one element that has been struggling recently, where we can find, maybe I will so that was early benchmark. I will show you out like this. Early benchmark been like a dotted line, whereas USCS looks higher. That's why we need to revise this one, and the question is whether the market is discounting the scenario of a early benchmark, or is it yet still to get delivered by this term. So that's why we still have some concerns about what the future of the labor market may look like. For now, however, payroll jobs in the nation remaining essentially flat, with a slightly lowering tendency. All right, let's get to market outlook, and we'll watch the markets with trading view. So recently we can see some downsides on many of assets given year-end position adjustments. Friday and previous Friday was maybe even the last liquidity day of 2022, where we had this triple witching event where many options have expired. So as there are not much of the capital on the market, we can find there any type of moves that are right now occurring, even this rebound on DXY, and this alongside move upwards on WTI as fake outs. So we were more destined to go on WTI USD to another important support at 62.5. In the meanwhile, we've decided to move upwards, as market makers are right now playing with such liquidity, faking some types of moves this way or another. So I would be very cautious in terms of stock market right now. There are many of elements that may seem dodgy That's why if you are not experienced a trader or investor, just I would lose it as it is. All right. So be it as it may, right now let's jump to market outlook and to crypto outlook as a next section. So on crypto outlook, that's a very nice map that's been prepared by Bloomberg. So that's the all bumpy road the crypto have gone through. So since January, we had some slump regarding interest rate hike been delivered by Fed, and right after this military warfare been initiated by Russia, and that's why we had that slump. However, the streak of events right after wasn't much more positive. Back in February, we had a wormhole hack. Right after there was a SEC fines that was fining BlockFi. That was the presage of upcoming regulations to a crypto table. Afterwards, a Ronin hack where hackers stole about 600 million from this protocol. The blockchain breach, that was the blockchain breach platform connected to online game Axie Infinity, where even Binance has invested around 150 million bucks to plug the hole. Anyway, the breaches are one of the most critical points among others, where there are kind of many bugs, many vulnerabilities that hackers using the most. So the question is right now whether after Terra collapse in May or Celsius that froze withdrawals, 3 arrows that filed bankruptcies, and many other events alongside with the most important recently FTX bankruptcy, will we see a fix for all the ways crypto broke in 2022? Skeptics and fans alike expect more rules and more regulations, especially in the realm of consumer protection. Anyway, crypto became a religion for many, and without a doubt, that leads of its believers, that loads of its believers will stick to the industry, whether it's good or gloomy days. So, as I claimed, skeptics and fans alike expect more rules and more regulations, and that's what I would bet on to happen in 2023. But possibly will achieve the bottom on the industry market capitalization within next weeks and months. About the turn of events on crypto industry, I will get you informed next episodes. That's why I highly invite you to subscribe. So also, if you enjoy, just hit this like button beneath the video. Also, we have a chat going on live. So if you are wondering about any topic, you may pose a question right now. Right now, jump to market mover section, and for this one, we'll switch our windows. For this one, I need you to hang on for a while. All right, so we are jumping to earnings calendar. At first, So we had yesterday Nike, Micron. Micron was the one of the biggest company that had its earnings release yesterday, and it turned out that EPS has been lower than forecast as well with revenue, but these are the slides. So I wouldn't really bother about this underperformance, especially with that the market has reacted to such news with a positive reaction. That means that market is discounting that Micron should get over many headwinds that already been going through this year. All right, so economic calendar tells us one thing, that the most important elements has been already released, but if we just make a zoom out, we can find that inflation rate out of Canada, yes, it was 6.8, whereas existing home sales at a minus, much bigger minus that than forecasted, and we can find what we can find next is initial jobless claims from US. Let's find out how that happened and how it looks. So right now on a 1 year scale, we are in a kind of a rough territory where this jobless claims are not very high and remaining within a I would say within a zone of 160 and 260. So right now I don't find any red alerts for this one, but as I said, the labor market bringing some negative tendencies. That's why we would observe these elements. In terms of other elements to watch is personal income tomorrow and inflation rate today in Japan, especially for those that are observing USD JPY pair on